Your money, your business. This is Financial Poise Radio, the spoken word sister of financialpoise.com, the internet's most trustworthy resource about finance, investing, business, and law.
Hello, everyone, and welcome to Financial Poise Radio. I am Christopher Cahill. Stay tuned, and you'll hear David Drake, who is a man for all seasons and time zones, talk about debt crowdfunding, kind of updating us on debt crowdfunding. It's not the same as equity crowdfunding. With debt crowdfunding, you're buying a stream of payments owed by borrowers. Equity crowdfunding, you're buying pieces of ownership in companies. Well, Mr. Drake is the founder and chairman of LDJ Capital and Soho Loft, a man about town and a man about the world, and he's a lot of fun to talk to. So stay tuned. For that, let me tell you about an article that was uploaded onto the financialpoise.com site just a few minutes ago. And it's part of the Get Financially Fit series written by Michelle Gershfeld, who was a guest on this show a while back. Great talk about personal finance. So, you have lightning, fire, earthquake, any of these things can destroy your home. You really know what's inside your homeowner's policy. Well, do you? Not only do you know what's in there, what does the coverage mean? How do you prove what it is you have so that the insurance company can compensate you according to the policy for the scope of damages you've suffered? Well, if you don't know, you might be losing out in the future. Let me give you an example. Let's say that when you were younger, you made friends with a starving artist who had just gotten out of prison or something, and that artist started making pictures, and they were pretty well received. And that artist has parlayed his gift for Blarney and his ability to ingratiate himself with celebrities, and now has quite a following. So that little picture he gave you for helping him move or something way back when is now worth several $1,000s. Let's say that he continues to be famous and have his works now placed in museums. And then, alas, a massive heart attack, and he dies. What does that do to the value of that piece of that etching or that painting on your wall? Well, it should increase the value significantly. So what was once a few $1,000s, what was once actually nothing, now then a few $1,000s, has become worth tens of thousands of dollars. Well, does your insurance policy provide replacement value or current value? How would whatever your insurance policy provides affect your recovery if that precious painting or etching is destroyed in a fire or earthquake? How do you inventory your assets? What assets do you inventory? Well, just as a forecast, Ms. Gershfeld suggests that you make that record with your phone, load it onto a thumb drive, and keep a copy in the cloud. That way you don't have a piece of paper somewhere that gets consumed in the flames that lists everything. One side benefit she does not mention. You go around your house photographing and considering what's valuable. You're also going to be noticing what's not. Maybe this is an opportunity to decrapify your life, getting rid of some of that stuff. Well, let's move on to economic freedom. The famous Austrian economist of the mid-century, Friedrich Hayek, wrote an essay in 1945, The Use of Knowledge in Society. It's a great essay, a fundamentally important essay, which can be found at the Library of Economics and Liberty. I'm going to tell you about this essay because I want to tell you about a board game that's quite the hit these days, to which this essay is relevant. Anyway, you can find this at econlib.org, which is where you can find a lot of other valuable essays in economics. He asks, and this is right in the immediate post-war period when communism, socialism, and capitalism were contending for real estate, actually, in the middle of Europe and in the Far East. What is the problem? He starts the essay with, what is the problem we wish to solve when we try to construct a rational economic order? On certain familiar assumptions, the answer is simple enough. If we possess all the relevant information, if we can start out from a given system of preferences, and if we command complete knowledge of available means, the problem which remains is purely one of logic. There Hayek encapsulizes the promise of the command economy. The promise of the command economy, by contrast to a market economy, is that you can eliminate the injustices and the illogic of a market economy and seemingly illogic of prices, too many luxury goods, etc., by having a few knowledgeable people who are logical and who possess all the relevant information and know all the preferences, can command the means and thereby allocate goods. That's the promise of what I will call hard socialism. He continues, a few paragraphs down, and this is all I will read from Hayek. The peculiar character of the problem of a rational economic order is determined precisely by the fact that the knowledge of the circumstances of which we must make use never exists in concentrated or integrated form, but solely as the dispersed bits of incomplete and frequently contradictory knowledge which all the separate individuals possess. The economic problem of society is thus not merely a problem of how to allocate given resources, if given is taken to mean given to a single mind, which deliberately solves a problem set by these data. It is rather a problem of how to secure the best use of resources known to any of the members of society for ends whose relative importance only these individuals know. Or, to put it briefly, it is a problem of the utilization of knowledge which is not given to anyone in its totality. How do you aggregate the preferences of society? Do you find a few smart people and give them all the information? Big data, for example? They can't do it, according to Hayek. There's just too much and too contradictory and too subject to individual choices to know. The market, by contrast, is a supply and demand system. And you can contrast the standard grocery store under Soviet communism with the standard grocery store of today, where some 50 or 80,000 different items exist, where the grocer knows you will fire the grocer and not come back unless the grocer has the item you want, when you want it, and available in the quantity you want it, none of which you have told the grocer ahead of time. Through the signals of pricing and of buying and buyer behavior, the grocer is able to divine something and respond in advance to desires you will possess at some later undetermined time. And so we don't have lines for goods. Quite a different story in the Soviet system, quite a different story in the pre-Deng Xiaoping Chinese system, quite a different story in North Korea and Cuba today. This gets us to the board game. The board game is called Kolyeka. That's K-O-L-E-J-K-A. I apologize for mispronouncing it, which I'm sure I am doing, which was developed in Poland. And Kolyeka is Polish for cue or lineup. It's a board game launched in 2011 by Poland's Institute of National Resemblance. It sold 20,000 or so its first year. Now it's selling 100,000 every year. It was designed to teach young generations about the hardships under communism, particularly the difficulty of acquiring consumer goods in the shortage economy. Now I'm kind of quoting from Wikipedia, which is already enough source for this. Very briefly, the game is played by 2 to 5 players, each controlling 5 pawns, represent family members. So each family needs to do some shopping for events such as birthdays or holidays and such. Problem: the stores are mostly empty. There is no certainty as to what will be delivered and where it will be delivered. This is the flip side of the uncertainty faced by the American grocer. Here, you don't know where anything's going to be, and somehow you've got to be there when it arrives. The players have to decide in this game which store to queue in front of, and can play various cards, event cards such as "This Isn't Your Place," "Colleague in the Government," that would be helpful, or "Store Closed," so that you can change the order of the pawns in the queue and maximize your utility or that of your family. And I can tell you from my friends who grew up under such conditions, sharp elbows, grim determination, bribery, friends in the government, all were essential to putting food on the table above and beyond your work for the week. And it also helped in some cases to have relatives in the countryside who had a small plot of land so that you could can fruits and beets and store up potatoes for winter sustenance. So, contrary to the Decembrists, the rock band that's nostalgic allegedly for the Soviet times, it was not a jolly time, but this game is a jolly game. If you look at boardgamegeek.com, you'll find many reviews of it, some of them by people who grew up under the regime, one of whom wrote, "Poland in the 1980s is all frustration, absurd, comradeship, and laughter through tears. This game shows all that in a very simple way, and that is why it is genius." I'm not sure whether David Drake is a genius or not, but let's listen to him. We are here with David Drake. David is based in New York City and is the founder and chairman of LDJ Capital, a private equity advisory firm, and of the Soho Loft, an event-driven global financial media company. This does not exhaust Mr. Drake's many endeavors, but we'd like to point out here that David has always been a strong advocate of both innovative investing in early-stage equity and of the United States Jobs Act from the very beginning, on behalf of which David lobbied both Congress and the European Union Commission. Because of his leading work in this regard, David was U.S. Commerce Department delegate to the EU Commission in Brussels and Rome and was invited to the May 2013 White House Champions of Change ceremony in Washington, D.C. So let's talk a little about the Soho Loft. The Soho Loft produces and sponsors more than 150 events globally each year. This month, June 2016, David will find himself in Athens, Istanbul, Cyprus, Marbella, Sevilla, Lisbon, Beijing, Shanghai, Hong Kong, Seoul, Barcelona, Casablanca, Milano, Verona, Sirmione, and Lugano. Well, somebody has to do it. And I think it helps to be polylingual, I'm sure, as David is. Mr. Drake continues to advance innovative investing through his speaking engagements around the world and as a regular contributor to Forbes and Thomson Reuters and other like publications. He co-authored the book, Planet Entrepreneur, the World Entrepreneurship Forum's Guide to Business Success Around the World, and is also the author of Crowdfunding Economy. Thank you, David Drake, for being with us again.
Thank you, Chris, for having me. It's a pleasure, as always.
All right. Well, you recently published a piece, and this would be May 19th, 2016, on the Soho Loft News. I encountered this piece the way I encounter a lot of writings on business these days, on LinkedIn. This is how things get learned these days. In that piece, you argued that debt crowdfunding will gain ground in 2016. The name of the article is Top 4 Reasons Why Debt Crowdfunding Will Gain Ground in 2016. So let's pick this apart. What do you mean by debt crowdfunding as opposed to other kinds of crowdfunding?
Well, good question, Chris. And what we've done is been tracking the crowdfunding industry for the last 5 years. I was part of creating the Crowdfunding Association, an advocacy group for the crowdfunding intermediaries that incidentally worked with SEC for literally 4.5 years straight through since we organized the first meeting at the SEC April 20th, 2012. The Jobs Act was created March 8th by the House 2012, led to President Obama signing into law April 5th, 2012. The year before, my family office, where we invested in maybe 40 different companies, had launched a conference business to put together our family offices. It did not work out as we expected, but instead we ended up becoming the only conference organizer under the Soho Loft brand that had 4 events a month talking about the Jobs Act. But in 2011, the Jobs Act didn't exist yet. As I mentioned, the Jobs Act was created March 8th, Jump Startups Act, in 2012. So while my speakers were talking about how to create jobs, and being sub-commercial witnesses, we had fresh content at every conference nationwide. So fast forward today, I decided to start tracking and researching the industry because we didn't have an investment those days, and we decided not to invest directly in the early years because it seemed to be oversaturated. In January 2012, when Patrick McHenry, who wrote the Crowdfunding Act for the Jobs Act, spoke at our event under the Soho Loft brand that I owned, by the end of the year, there was 2,000 crowdfunding sites. And I realized, wow, this is interesting, but they don't have the money, they don't have the deals. And Kickstarter, Indiegogo, and Rocket Hub were all ready at the lead, as well as Lending Club in the space they were focused on. So over the years, I tracked and followed all the industries and decided to focus in on certain industries such as real estate and metals and mining as our private equity divisions and investments as a family office and dozens of other family offices working with us globally was already in the space. So by 2012 to 2016 today, we tracked 300 real estate platforms using crowdfunding. And as we do reports every year, 14, 15, and 16, the 16 report is coming out next week on the website called Time Realty News. We take the top 20 real estate crowdfunding platforms in the world, and the tendency is that equity just takes too much effort and time to raise. And the debt is easier and more comfortable for investors to deal with. So I'd say 90% of the deals today in real estate, which is really the largest area of crowdfunding after Lenders Club and Prosper, which is dealing with non-secure loans up to $30,000. Real estate is the second largest one out there right now. And they're seeing a heavy growth to over $3.5 billion this year just in crowdfunding. And that majority of that is in debt. And Prosper and Lending Club themselves probably hitting over $10 billion in loan this year and next year. So, between these three industries, that's probably a good 80% of the whole industry globally. So with the real estate industry taking off, a lot of these loans are being done on crowdfunding platforms, and they're $150,000, $250,000, $500,000. Many of them are loans for single-family homes. A developer will buy it, and they need cash to develop it or refurbish it and flip it. So they're fix and flip funds.
David, let me stop you there, because I'm interested in your view on the following attempt by me at analysis. So it's your view that we've already seen a shift from equity crowdfunding to debt crowdfunding on the portals, which proliferated early. There have been a large number of portals, and as they struggle to survive, they've shifted more toward debt, I think you said, because it's simply easier to go about selling debt than it is to go about selling equity interests in real estate. Risk is a big factor. Do you think it's also perhaps the incentive on the part of the portals is that you can break up lending pieces and perhaps into smaller bits and have more transactions and therefore more transaction fees? I would think that if that's true, that would be a powerful incentive.
I agree with you, Chris. You're right on that the speed of it also shows everybody else that they're getting money and returns. These platforms have to show returns for the investors because it's such a young industry. And by doing these shorter terms, people spread the word, and they're really competing with the hard money lending business. The 6 to 18 month loan, higher rate, but it's secured by the property. And you go in and you go out first. And that's where the transactions are today, the most of them. Yeah, we were hoping the more larger transactions would be happening, but, you have groups like Fundrise who recently announced that they're not going to be doing crowdfunding anymore. They started a crowdfunding group for 3 years, but now they're only dealing with private equity and larger developers.
They were not selling debt then? They were selling equity?
They were trying to do equity through Regulation A, and then they were doing Reg D and Regulation A for other developers, and recently decided just to be, a lender, so to say, with the relationships they have and not really doing crowdfunding anymore.
Yes, I think it's right with your theme. I should mention, by the way, that you're not the first person to come on this program and talk about debt crowdfunding, including debt crowdfunding with regard to real estate. Let me just quickly name who else we've had. We've had Brendan Ross from Direct Lending on episode 24, Jillian Hellman from Realty Mogul on episode 15, and David Manshuri from Asset Avenue on episode 7. So if you want to learn more about this particular, or at least what they were doing back, who knows, maybe they've changed the model a little bit since those episodes, because those were over a year ago.
Well, Realty Mogul is today the largest crowdfunding organization in the world, I would say, at least top 2. We ranked in our report, and, this year's report is going to be top 4 for sure. And they maintained the top 4 position for the last 3 years. And Jillian is brilliant. I consider her a friend. Asset Avenue has worked with us in the past, and they're very good in L.A., where they're based, as well as Jillian. And Jillian had an interesting history because she was one of the first companies to get an $8 million investment. Cannon Brothers from San Francisco had put that money in 2 years ago. And she did go a different direction than these other companies did. Cannon Brothers and the VCs invested in her. They said, you got money now, spend it. She ended up going in the direction of hiring 80 to 100 people. And the only crowdfunding firm I've ever heard of hiring anything remotely like that, I don't know anybody. So they went to hire a lot of people to source deals and underwrite deals. And they're doing most deals they're currently in the problem of the top 3 in the world in deal flow and deals closed. What's interesting with Realty Mogul as well is that they were rather agnostic of saying, we're not only going to do debt, we're going to do equity. We're not only going to do equity, we're going to do hotels. We're not going to do only revenue incoming property, but we would also look at ground ups, which allowed them to be rather agnostic to all kinds of deals, which was very interesting to see somebody do that. And I think they closed and got at least 60 to 80 deals paid out to their investors. So they have that in and out success of returning money back to the investors, which builds confidence. And I think that's very important in this industry, that these deals are shorter to build confidence. And that's why equity is more difficult, because that's a long-term, high-risk play. Maybe that helps answer your question.
Oh, yes, we have to understand the incentives of the parties if we're going to understand the industry, and you've been outlining that, I think, very well. I should mention about Jillian Hellman. I've talked with a lot of people in my life and on this program, actually. We're on program number 80-something at this point. She speaks in not only complete sentences and paragraphs, but well-crafted paragraphs, elegantly constructed sentences. I know that's not essential to her success, but I can't believe it hurt. I think it helped. But I just wanted to mention that. But let's talk about crowdfunding as a term. We've been using it, I think, in one sense, but it has more than one sense. Recently, Title II of the Jobs Act, which has to do with crowdfunding by the true crowd, that is everybody, not just accredited investors, but everybody, was strengthened by the issuance, finally, of regulations which now allow it to actually take place. But we've been speaking only of accredited investment funding, which compared to the pre-Jobs Act period truly is a crowdfunding, but it doesn't involve everybody in the country. Maybe 10 million Americans would qualify. Is that how you see it?
Yes, and I know 2 years ago it was actually 8.6 million accredited families in the U.S. And according to the SEC, the definition of accreditation is, as an individual, you had earned $200,000 in salary the last 2 years or income, and expect to do it next year. Couples, $300,000, or individual couples having a net worth of $1 million excluding your home. And that had been around 8.6 million individuals in that category in the U.S. alone 3 years ago, maybe 4 years ago. I think it was 2012 we had those numbers. Today, I'm confident this is closer to 10 million. And as you said, there are 2 new laws out there allowing you to do crowdfunding and take money from non-accredited. And, would you want me to discuss that, Chris?
Well, no, not so much. Although, let's just shift this a little bit to a more international perspective, because you're in a peculiarly well positioned, given your travel schedule, with nothing else, to comment on that. You do global reports. When you talk of accredited investing, I think you're able to talk of it elsewhere besides the U.S. And Is broad-based, that is beyond accredited investor crowdfunding, more common outside the U.S., and has it had an effect on debt crowdfunding in real estate?
Well, I've spoken about crowdfunding at the Parliament with Sir Attenborough in London. I've spoken about it in Stockholm, Moscow, and Dubai, and as well as in my book, The Crowdfund Economy, that I launched May 16, with the 7th law of the Jobs Act, which allowed for crowdfunding under $1 million was released. You know, what's interesting is that abroad, their form of accredited is not the same as in the U.S. They don't have that requirement. In London, for instance, you have to, self-answer questions that you know about the risk for early stage investments. And many of these countries have limitations on who can invest, but not based on their income per se. You know, the exemption in Stockholm for crowdfunding allows you to do crowdfunding based on you can only have up to 200 investors, but the deal has to be done between the investor and the issuer directly. So the exemptions exist around the world that people use for crowdfunding, and as you read in the book, you'll see there's only 2 laws that have the word crowdfunding in the law. The first one was in Italy 2.5 years ago that I broke the news for on Forbes, and now as of May 16th, the first law with the word crowdfunding in it passed. And I think it's interesting to also use an acronym I came up for my book, and I said 2 more people investing for something online under the acronym SPICE. If you give money, 2 more people online towards a service, product, project, investment, cause, experience, SPICE. Then to me that's considered crowdfunding when you do it online. Now, of course, the Europeans will argue that crowdfunding for debt is not crowdfunding in their eyes, while in the U.S. we put that in the same category. So there will be a regional difference between the continents.
I guess in the U.S. crowdfunding means buying securities, whereas in Europe maybe crowdfunding means buying a piece.
Well, in SPICE, the investment portion is what we're discussing today. But crowdfunding for Kickstarter, Indiegogo, there's no security, so that would fall under service and product and projects.
Well, I guess there's no reason to believe that the dynamic is fundamentally different outside of the U.S. with regard to shifting from crowdfunding in real estate from equity to debt. One would assume that that's the same dynamic the world over. Is that correct?
Correct. Yes, you're making the right assumption, and from the research and the work and the book I wrote, that stands everywhere. Because it's a shorter period of time, and you also, if there's a problem, the debtors get paid first. So it's a quicker, more safe investment because you are senior to the equity holders to get your money back if there's trouble. Yeah, it's a risk profile.
Oh, definitely, and as a bankruptcy attorney, I assure you I understand it. And certainly David Manchuri, when he was on talking about Asset Avenue, made sure to emphasize that because that is what he's selling, essentially, is a privileged spot in the stack.
Yeah, and the critique, from my point of sight is, I founded 2 angel networks. We've been general partners in a couple of VC funds. And it was more educational for me, and we're still doing investments in the space as well as in crowdfunding. But my world has always been family offices, private equity institutions. So we're using the technologies of these industries for the family office institutions globally, internationally, and locally that we've been working with for 20 years. So granted, I kind of fell into this industry by accident and managed to build myself a name for being there in the early days, being able to start the Crowdfunding Association. I resigned from that, and I continue writing about it. But my main work is for my multifamily office to build out 2 divisions. One is the financial media company, the Soho Loft, the conferences, and a half a dozen magazines we own online, all talking about how do you find your investors. That's what the financial media one arm is on the multifamily office. The other portion is going back to the trip I'm doing, the International Investment Bank that we're launching 2017. So that's why I'm going on this roadshow, because I have now 10 new offices. 60 directors. Some of them ran Intel Capital globally. One is a former minister for Macedonia who's been working with my family office for over 10 years. So we have some amazing people from autocracy to groups who ran Benchmark VC Fund and founded it itself in Europe. And we're using some of the technologies that you can find in crowdfunding, but we're doing it for the private and elusive world of family offices that sit on $100 million to $1 billion in assets. And we have over 45 of those clients co-investing with me personally in all kinds of industry across the world. And so I'm applying a lot of those technologies and solutions to those families. So I see a lot of parallels, and they're all doing the same thing. They're automating the processes out there to be digital. From signatures of contracts to escrow accounts to automation of doing anti-money laundering for foreign investors coming to the U.S. to just the data room with documents. And one of the biggest changes is you're saving hundreds and thousands of dollars on legal fees because of these efficiencies. Of course, lawyers will never be replaced. Broker-dealers will never be replaced. And what's happening in the crowdfunding industry today is they're becoming a balance between them, angel networks, venture capitalists, lawyers, and bankers, and investment and broker-dealers. And they're all starting to work together. Broker-dealers will go to the crowdfunding sites and say, hey, you did really well. You raised $1 million in 2 days. Let us work with you now and help you raise $10 million. And that's what's happening now. And that's how the landscape is going to fall out over the next couple of years. The only exception to that was Lending Club and Prosper, doing non-secure loans up to $30,000. Even if you want to go on a honeymoon, you can get a loan. And these companies were able to do $300 to $500 million in loans per month. Sequoia put money behind Prosper. So in that space, you get two companies that are larger than all crowdfunding debt lending in the whole world. So it's interesting to see how that evolved.
Let me ask you a different landscape question. You act on behalf of family offices. Family offices are seeking a return on their investment, of course. Let me just ask a unfrozen caveman observer question. The family offices are looking at what we've been calling crowdfunding and debt crowdfunding, which in the grand scheme of things is called alternative investing because it is not investing in public equities in the stock market. And we are told and we know that public equities in the stock market in Europe, for example, and even elsewhere are not returning what they ordinarily would. And so there's been movement to greater amounts of alternative investing. Do you think that explains how much of the investment activity you see from family offices is explained by the lack of return from public equities and therefore the systematic attractiveness of alternative assets?
The family offices are not doing crowdfunding, and they will never do crowdfunding. The family offices are going after alternative investments because the stock market has been volatile. Their allocation of bonds and stocks is fixed. And for alternative investments, it's, real estate is the next big thing. And the real estate market will stay very strong in the U.S. The reason being is that in 2010, we started seeing more people retiring in the U.S. than going into the workforce. And the pension funds, having lost money in the crisis, they already have a full allocation for bonds and stocks and securities. So they're going to have to go after alternative investments. And the biggest asset class for that is real estate. So not only are foreign entities like China sending billions and billions of dollars, I think close to $6 billion left China for U.S. real estate last year, mainly real estate, and that's going to continue. The real estate market is very strong, and, I believe it's going to continue like that for another 30 years because there aren't many other industries or alternative financing that are large enough. For instance, there are a couple of groups trying to do fund-of-fund structure in the crowdfunding industry, but the truth is there's not enough deals being closed and not enough large deals being closed in the crowdfunding real estate industry to justify a huge jump. The whole industry may be done $3.5 billion this year. Meanwhile, Prosper is doing, probably around $400-500 million a month, and they just bought it from Sequoia literally 3 years ago. As just one company compared to the whole industry. And the family offices are certainly all more and more looking to the U.S. for alternative investments. And, we have products that's non-correlated to economic downturn and political downturn, such as trading electricity. That has nothing to do with the economy or financial situations. You need to have the lights on, which is related to the weather. And there are other non-correlated alternative investments, such as real estate, as well as, hard money lending. And we've seen families such as Saudi Arabia put in $5 million to hard money lending, which is really, crowdfunding for debt. That's happening most of the places. Like Patch of Land does crowdfunding for lending and only short-term small loans. And they put in $5 million 2 years ago. But Saudi stopped investing in the U.S. for the last 2 years because when I was in Dubai, in Abu Dhabi, in December 2014, a year and a half ago, they had an OPEC meeting. And the advisors of the family said, we want to stop the innovation in gas and oil production in the U.S. We're going to reduce the cost of it to such a level that 100 companies in the U.S. will have to go out of business. Today, 100 U.S. shell companies are in bankruptcy. So they accomplished that. The question now is, can they reverse that and increase the price if they want to, especially when Iran came out. So there's a lot of movements happening. But the nice part here, Chris, is any crisis we have, because I've been writing this since 1998, New York Real Estate Journal, where the Russians defaulted on their debt. Right. That's that year. Every crisis we have, people look for capital preservation, safe haven, and preservation of capital. And because of the legal justice system and infrastructure of the U.S., they feel that they have transparency and recourse. And they feel that it's a safe haven to invest in U.S. real estate and U.S. treasuries. So every disaster that's been around the world, financially or even politically, capital's been flying to two major markets, London, Hong Kong, well, three markets, London, Hong Kong, and the U.S. And U.S. has always been seen like one of the biggest safe havens out there.
So, yes, so when one is thinking about alternative assets broadly, one cannot forget about, and I'm just summarizing what you said, I think, the two aspects of real property in the U.S. and perhaps a couple of other places is the size of the market and the role it has whenever there's a flight to safety by anyone that makes it so attractive and so big that it's always going to loom large among alternative assets.
Hey, Chris, not everybody had the experience. They wake up, $100 million now worth $10 million.
Yes.
And I hope I will never have that experience, but that's what the stock market can do for you. So, they all want to diversify and make sure that they don't have exposure to lose everything, because I know several dozen people who've lost hundreds of millions of dollars and had to start from scratch.
That is tough, to say the least. I'd like to finish our discussion by talking a little bit more about your Soho Loft business. It's perhaps not as sexy as some of your other businesses, but I think it's really interesting from an analytical standpoint if you want to understand what's going on in the world of, anything from fintech to the dynamics you were just addressing. So Soho Loft has a lot of meetings every year, 150 or so. I guess I'm wondering whether looking at those meetings themselves, if somebody just looked at how those meetings change from year to year, if one would get a picture of how things in reality are changing from year to year, if you follow me. And so I ask you, how is it that these conferences get determined? How is the dance card of Soho Loft filled?
Well, today we mainly have only private road shows and private family office meetings set up, and that's not available to the public. And the 150 to 250 events we sponsor every year are all based on finance. They're all about the core of the Soho Loft brand, which is we have access to your investors. Whether it's a newsletter, an article, a Wall Street Journal article that I'll write, or the weekly articles I write for Huffington Post or Forbes, or an editorial for our family office today publication, or a conference out of 300 that we recommend you go to because your investor will be there. We're not anymore selling tickets per se to most of these conferences, but rather want to guide and help people help themselves. And the Soho Loft is the core to getting you to the investors that you need. And we'll give you the tools to find them, meet them, interact with them, and speak with them. We have 100,000 large database of global investors, with the majority being wealth manager, asset manager, private equity funds, hedge funds, and endowment funds, as well as family offices. And as we're nurturing all of those relationships through our media, we are letting startups and our young companies educate themselves for free on the site. And eventually we're going to start giving them free courses to help them understand what they need to have ready for the investors they're going after. Now, we're involved with 150 events with investors sitting on the panel telling 400 startups at these events how to pitch them, what they want to see. So I think going to these events are great, and for the majority of these, we don't make any revenue at all. We just want to help people to understand what alternatives are out there for you to meet the investors. Those investors will teach you what you need to know before you're ready to meet them. So eventually we'll put that on the Soho Loft as well and say, here's 5 things you need to keep in mind before you go to this event to meet an investor, because they're going to want to see this, this, and that.
Okay, so you're brokering access and brokering information for those who invest in those at this level and those who can provide investment opportunities at this level.
No. The Soho Loft News and the Soho Loft Media Group connects people to the investors, and there might be 20 different services for them to meet the investors. Now, we're not a broker-dealer, so we cannot take a commission for matching people up, and they will have to interact with the money in a relationship directly themselves.
I was using the term in a secular sense. I was being unclear. I didn't mean that you were taking a fee, but rather that you're bringing people together because you have the ability to do that. Unique ability, perhaps.
I have the insight of understanding all the different ecosystems, from crowdfunding on a global basis, Poise, and all of the different variations, to the 3 laws under the Jobs Act allowing you to do it, to other laws abroad, angel networks, being a founder of 2, part of 4, venture capital firms, as well as family offices, private equity, institutional, and pension funds. So understanding all those ecosystems, it gives us a great way of giving back to the community, of saying, hey guys, I know there's hundreds and thousands of startups. Let me give you free information so you can help yourself. And guess what? When you guys get really big one day, and I have a service that can help you, and you're reaching 100 million, maybe you will thank the free services we gave and keep us in mind.
Well, David, if somebody who's listening wants to start learning what it is you can teach, I mean, speaking just in terms of online sources that you do provide, where would you direct that person?
I would just direct them to read about startups at any publications and capital access, from Thomson Reuters for private equity and venture capital to, crowdfunding and angel investors and venture capital on our site called the SohoLoft.com. And that would allow them to just read and see what's happening. Go to Huffington Post and read my articles there, where they have 50, 60 articles. The information is out there, and, within 6 months, we will organize all of that to courses to help companies help themselves at no cost to them.
Very interesting. And when you do, I hope you'll come back and let us help spread the word.
And then last thing to leave everybody with, the Crowdfunding Economy, the book that I wrote, will be found on that website, the Soho Loft. And if you have a chance to buy it, please do, and I'll always be available for people reaching out by email.
All right. Well, David Drake, founder of LDJ Capital and of the Soho Loft, once again, it has been a pleasure having you on this program.
Thank you, Chris. You've been great. I appreciate it.
All right. You've been listening to Financial Poise Radio. I am Christopher Cahill. Financial Poise Radio is produced by Stephanie Strait. Thank you all for listening. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.financialpoise.com. Each week, Financial Poise Radio brings you news and education about finance, investing, business, and law. To see a short written summary of this episode, go to www.financialpoise.com. Financial Poise Radio is a production of Financial Poise Radio Productions, LLC.